The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. And with me today, as always, is the senior Chanticleer columnist at the AFR, Tony Boyd. Tony, how are you going?
Really good, James, and glad we've come round to another Friday.
Absolutely, what a week. And we're joined again by our newest recruit to the Chook Pen, Street Talk guru and soon-to-be Chanticleer columnist, Anthony Macdonald. Anthony, welcome back. It's been some sort of week.
Thanks, James. Yeah, can't wait to pick through it.
Fantastic. Well, this week we're going to take an in-depth look at the chaotic week on global markets, from the collapse of Silicon Valley Bank to the wave of panic set off by Credit Suisse. We'll look at how it happened, what comes next, and what it means for Australia. But first, gents, I wanted to check off on that other massive yarn of the week, confirmation that Australia will invest up to $370 billion on nuclear submarines to shore up our defence forces. It's a massive number, and a policy that some pundits, including quite colourfully the former Prime Minister Paul Keating, doesn't like. You can always trust a fund manager to bring it back to dollars and cents, though. One pointed out to me this week, it's about the same number that the Australian energy market operator has estimated we'll need to spend on the energy transition. Tony, which bit of spending do you like better, defence or decarbonisation?
I'm going to go with decarbonisation all the way. And James, the reason is I have no confidence that defence can manage a project of this proportion, given their appalling track record over the years on just about everything they've done.
Yeah, it's a good point. I hadn't thought of it in that way, but you're right. It's we've had a few sub disasters in the past, haven't we?
Well, I mean, buying subs from the other side of the world's not new. In fact, my late father-in-law, David Lorimer, was Lieutenant Commander of the first Oberon-class submarine, which was brought to Australia in 1967. Now, those subs were amazing because they were so quiet and you couldn't see their heat trails from space. So they were very effective. Whenever they had war games with the Americans, they got through their defences. And I thought it was an interesting point that Paul Keating made this week, that you can see these nuclear subs from space. They'll be very easily identified by the Chinese and will be picked off quite easily. Now, let's hope the technology behind them advances to the point where they can be used in a stealthy manner, but I am concerned about that as well.
Fair enough. I feel like I've entered a episode of Hunt for the Red October or something here, but run silent, run deep, perhaps. I've always been a big fan of Das Boot as well. Anthony, $368 billion. It's the one thing here is yes, it boosts GDP as a one-off spend, but it's not quite as productive as, say, the energy transition would be. Can we pull off both?
Well, there's a lot of money that's going to have to come from somewhere. And, you know, like we're seeing everywhere at the moment, the governments have just got their hands in their pockets, just continuing to dole out so much cash. And I think we've got to remember that we're all the taxpayers. We're going to have to pay for it some way. And it's kind of hard to see how it's all going to come together.
Absolutely. Not a bad point as we approach the federal budget in May. Anthony, I also wanted to get an update from you on the fate of Sun Cable. Now, this is the giant renewable project that was supposed to deliver solar power from a solar farm in the Northern Territory all the way across to Singapore via a 4,000-kilometre undersea cable. Unfortunately, the project collapsed in January, but its two biggest shareholders, Andrew Forrest and Mike Cannon-Brookes, they're still very interested in buying this project out of administration. Where are we at on this? What did we learn this week?
Yeah, so the receiver came out this week and said that it elicited strong interest, the project, and received multiple non-binding bids last week. So they're opening up the data room for the second stage and they'll call for proper bids in April. Talk about multiple bidders obviously had everyone scrambling around looking to see who these bidders were.
Yes.
Now, it's the first time anyone's been able to have a look at Sun Cable in probably 18 months. You know, like these, it's quite an ambitious project, and Sun Cable's, you know, had a lot of technical sort of reports done. They haven't really shared it with anyone, haven't shown anyone for 18 months. So I mean, there must have been a few tie kickers take a look, but I'm so sceptical that anyone other than Andrew Forrest or Mike Cannon-Brookes will end up owning this thing. I mean, these two, they put a stake in the ground a couple of years ago in Cannon-Brookes' case and Forrest's. They clearly like the idea of being involved in a huge project of this scale. They're both quite unpredictable. They're unconventional. They've got a lot of pride at stake. And I reckon the risk is that it ends up being just a really hard-fought battle between those two. And, logic just completely is out of the equation and it goes for way more than it should because these two want to beat each other rather than someone coming in from left field.
Interesting, when I interviewed Andrew Forrest last week at our business summit, how he said the offices of Sun Cable were more luxurious than FMG in that they'd basically been burning cash on things that weren't really getting the core business like achieving its goals. That's a bit worrying, isn't it, Anthony?
Yeah, I was up in Darwin last year and I was out on a fishing trip and the fishing instructor was saying how he had these mates that he knew that worked for Sun Cable and 5B, which is the group that makes the solar panels. And they have had these tech-style offices with kombucha in the fridge and everyone in Darwin thought they were just crazy.
Yeah, well, this is the startup. We've yet to talk about the startup culture in Silicon Valley, but it's all about tech. It's not about prudent banking either. So, interesting who gets to own that one.
It's always a great fund managers love talking about how the impression that you get from a company's office is always really important. Have they spent too much on the foyer or, to your point, Anthony, the kombucha in the fridge? These fundies, they love it when these businesses are run lean. So, maybe the kombucha index is one we need to look at next time. All right, well, it's been a massive week on global markets. Really, I reckon a once-in-a-decade week. And today we're going to take a really deep dive into what's gone wrong, why it's gone wrong, and what might happen next. The rot really started Friday night on our time when a previously little-known regional bank in the US called Silicon Valley Bank, or SVB, was shut down by US regulators after depositors withdrew $42 billion in the space of a day. But within the space of a couple more days, the bank's depositors, including an army of growing tech companies, had been rescued, with the US government and the US Federal Reserve stepping in to guaranteed uninsured deposits. Now, Tony, a lot of people have pointed out that SVB had a unique clientele. It was the go-to bank for the venture capital and tech sector in the US. Did that make things worse here, or are there some other big factors at play that we need to think about?
Yeah, I think it did make it worse, James, because what happened, all of those tech companies that were flooded with capital just put it in the bank on deposit, and the bank itself couldn't lend the money fast enough, so it invested in what we call a carry trade. They put the money into bonds, but of course, as interest rates went up, those bonds plunged in value, and it was obvious to everyone who looked at it that if you took the unrealised losses on the bonds, it'd wipe out the bank's entire capital. And just to give you an idea of how unstable this whole mismatching was, they had $173 billion of customer deposits and $152 billion was not insured. So basically there's about $100 billion worth of bonds in there that really should have been matched on the other side but weren't. So that's a really quite a egregious failure of risk management by that bank, and the regulators who were overseeing it, they would have got the numbers every month but didn't do anything about it.
Yeah, the other thing here is that we saw the tech sector really freak out twice, I reckon. They freaked out on Thursday night when they realised that Silicon Valley Bank was a bit unstable, and they all rushed to get their money out all at once, having previously decided this was the cool bank that you wanted to work with. And then they freaked out on the weekend as they faced the prospect of their uninsured deposits being locked up for a few months, and they rushed to demand a government bailout, which, to be fair, they eventually got. Anthony, I guess the tech sector's worst fears that this money could be locked up and they wouldn't be able to make their payroll and operate their businesses, those fears were quickly dispelled. But will this have a longer-term impact on the tech sector, do you think?
I think you're so right, James. Like, the tech sector's done this to itself. It wasn't the whiff of the ratings agency downgrade or the bank write-downs of the bonds or the capital raising ultimately that undid the bank. It was everyone rushing at the same time to collect their money back. I mean, these founders did what they had to do, but they ran to the bank to get their money out because, their capital's so precious at the moment because the fundraising environment's really changed on them. So they all run to the bank and ask for their money at the same time, and poor old SVB just couldn't keep up. Now, so those founders and CEOs have now got their cash, but they have to go to another institution. They're going to, European banks, Japanese banks, the big other US banks. They're having to deal with banks that aren't as used to the tech sector, aren't as supportive of it, and they're now faced with less friendly terms for themselves, all because SVB went under.
Yeah, Tony, the speed with which this occurred, I think, is really fascinating. We've never had a digital run on a bank. We've had bank runs in the past, and people lining up at the branches and all that sort of thing. But this was a digital run at the bank. These tech guys were talking to each other on Twitter and on WhatsApp chat groups, and the speed with which things unwound for Silicon Valley Bank was quite staggering. I mean, do regulators need to think about this? Things don't move slowly anymore. We live in a frictionless world.
No, well, of course, I grew up in a world where the first run on a bank that I saw was the St George Bank in 1979. And there was John Laws, and I may have mentioned this on the podcast before, but the golden tonsils said that they couldn't meet their liabilities and get your money out. The Premier at the time, Neville Wran, had to go out in the street and say, St George Bank is safe. Do not try and take your money out. And James, you wrote a very good column on this about social media and the rumour mill in Silicon Valley and how everybody was getting emails, texts and watching those social media platforms as an indicator of how fast they needed to get their money out of Silicon Valley Bank. But this concept that regional banks should be not subject to the same regulatory mechanisms and rules that are used for all the big banks is just complete madness. I mean, at least in Australia, the regional banks here have the same rules and the same matching of assets and liabilities as the big four banks. And we know that that's a good system. And uniquely in Australia, APRA actually charges a capital charge if your assets are not matched with your liabilities. There's a penalty there to give you a big incentive. So I think the tech sector in America has been rescued by the federal government. Let's hope they learned the lessons from it.
Yeah. Well, we had a couple of calmer days, slightly calmer, but then on Wednesday night Australian time came the next big shock. Shares in Swiss banking giant Credit Suisse started cratering on reports that the company's biggest shareholder, Saudi National Bank, was not going to extend its support for Credit Suisse. And the stock fell as much as 30%, and that sparked a sell-off in bank shares across Europe and into America and into Australia. And then once again, we were faced with this sort of threat of contagion across global markets. And once again, regulators had to step in with the Swiss National Bank extending Credit Suisse $81 billion worth of liquidity to calm things down. Anthony, Credit Suisse has been in trouble for a while, so this has been sort of coming, I guess, but what are its problems and why did they suddenly get worse?
Well, the problem right now is just sentiment. Like SVP, we can sit here and talk about capital ratios on paper or liquidity coverage ratios or whatever, but at the end of the day, it's just sentiment. I mean, Credit Suisse on paper was actually all right. The CEO got up and said, all our numbers are fine. The regulator said Credit Suisse is fine. But sentiment just turned against them in the market, and all of a sudden it was just about trying to stop a run on the bank. So that's trying to stop customers asking for deposits back, trying to stop customers refinancing their loans away, or from counterparties rethinking their derivative positions. So, I mean, Credit Suisse has had a target on its back for a few years now. It's had a few scandals, which, anyone working at Credit Suisse in Australia would probably say is outside their control. You've got, or even in the US, got the Archegos hedge fund. They lost quite a bit of money. Greensill, they lost quite a bit of money. But Credit Suisse tried to rule the line under these recent incidents just 6 months ago. It announced a restructure. It raised US $4 billion in capital and tried to sort of lay the groundwork for the future Credit Suisse. and move on. But, I mean, you look at what's happened 6 months later and it's just sentiment turned against them again. And then, no amount of capital raising or restructuring or anything's going to get you out of this hole. It is purely just sentiment towards the bank. So I don't know. You just don't want to be the injured one in a market like this, right? So the only thing that's going to make it go away for Credit Suisse is if someone else looks more injured. And you've got SVB, you've got First Republic now, but Credit Suisse is the big one that everyone's going to focus on. And until everyone shifts that focus elsewhere, it feels like they're going to be in the firing line.
Yeah, indeed. Tony, were the Swiss regulators asleep at the wheel here, or is it the fault of the bankers? You wrote a strong column on Friday morning saying the bankers should pay for this bailout. Explain your thinking a little bit for us.
Well, yeah, there's this crazy proposal being put forward by the board and management of Credit Suisse to actually give all of the senior executives a bonus pool that could be worth up to 70 million francs. And it's called a retention award scheme, right, which, like, paying them to retain them in a bank that's just been rescued by the Central Bank of Switzerland. These guys should just do their day job and get paid for it. So that was my point, that this is a crazy sign of arrogance by Credit Suisse. But I do think that there has been a failing there of the Central Bank of Switzerland in not forcing Credit Suisse to get into bed with UBS, create a big national champion, put in place the right credit standards under UBS CEO Ralph Hamers, who I've interviewed before. He's a world-class executive who could knock this thing into shape. It has a very good asset management business, but it probably should abandon the idea of trying to recreate CS First Boston from many years ago. It was a very successful investment bank, but just let this thing sort of come under the umbrella of one big Swiss mothership that can compete in Europe. Forget about the global hegemony. Don't take on the Wall Street investment banks anymore. Just do your job in Switzerland and run a good, safe bank.
Yeah. And a couple of slabs of kombucha would be fine as a retention bonus. You don't need 70 million Swiss francs or something. So Tony, is that the next step, do you think, that Credit Suisse eventually has to merge, break itself up and merge with UBS or some other big bank to get the sort of strength required to withstand what's coming?
Well, just to put it in perspective, James, the market capitalisation in Australian dollars of Credit Suisse is about 10 billion. In other words, it's 1/6 the size of Macquarie Group, and it is less than 1/10 the size of Commonwealth Bank. In fact, the Commonwealth Bank is 166 billion, and this thing's 10. So, I mean, it's a morsel. But would the Combank buy something like that? Hell no. Its price to book is 0.2. People are saying that 80% of the assets of Credit Suisse are basically, you wouldn't pay for them. So I think they do have to come up with some sort of longer-term resolution. I can see how difficult that would be because of the cultural and personality issues. It reminds me of the 1970s when there was a merger of two big commercial banks in Australia, and the only way they could get that over the line to solve the cultural issues was to have a board of directors of about 24 people. Now, these are the sort of cultural issues that come up, but in this case, it's far beyond that. It's all about the financial stability of the global financial system, not just Switzerland and Europe. So let's hope the next G20 meeting brings up this topic and gets some action.
Yeah, jamming Credit Suisse and UBS together culturally would be so interesting to watch. Like for the past 15 years, whenever I've spoken to someone at UBS, so if UBS has got some good news to tell you they've poached someone and it's someone from Credit Suisse, they're cock-a-hoop. It's the best thing ever. Same as a Credit Suisse. If they can get one over UBS, it's great. They know that back in Switzerland, everyone's watching. Like, these are two big rivals. And we're a long way from Switzerland, and the Australians have picked up on that rivalry. Imagine what it's like closer to home.
So much for Swiss neutrality. Well, let's bring this back to Australia because this is the sort of important thing for our readers and our listeners here. Globally, it seems like the main spillover for the broader economy will be in the banking sector. There's probably going to be slightly tighter conditions, maybe less availability of credits, more competition for deposits. Tony, you made the point, though, our banks are in very good shape compared to what we're seeing in the US. And this is a really important point to note. We've got a much stronger supervisory system, capital levels. Our banks just are more conservative, I think.
Yes, that's right. And I think our prudential regulatory system works very well. The banks complain, of course, about the Australian Prudential Regulation Authority being too intrusive, and over the years they've had more and more power given to them because of things that have happened. But you've got to say they are exceptionally strong, and they're highly profitable. This is something that often comes up, but that's actually a good thing. So I think we're like an island of stability in the world at the moment, and we can thank our rules and regulations around banking, which are, as I said earlier, some of them are quite unique. They're tougher than other parts of the world.
Yeah, they're also only as good as the housing market and the unemployment rate, and I think we've been blessed on both fronts as well.
Yeah, good point, Anthony.
Yes, well, we haven't really had a recession since 91, a proper one, which means there's a whole generation of Australians who don't really know what it's like to live through a recession. And what I'm talking about is interest rates at 17%, unemployment at very high levels, defaults and insolvencies among banks, commercial property market absolutely slammed. I mean, it's just something you don't want to have to live through again.
Anthony, the deal market's already very quiet. Does this shadow from SVB, Credit Suisse, does that hang over deals and slow things down even further?
So all this is about the rate of change in interest rates and the lack of general liquidity. And like one or two things go wrong, it spooks people and everyone says it's a domino effect. But so I think everyone just sort of looks internally for a while and won't do anything a while. Like at the end of the day, if you're running Qantas or Rio Tinto or Transurban or Woolworths, like did anything really change this week? Like probably not. But it's all about sentiment. It's all about confidence. Everyone just wants to sit around and think about, what's it mean for us? But yeah, so underlying all of it is the interest rate change and just that repricing of capital and risk across the world. And it's not just that rates have increased, it's how quickly they've increased, right? So the widely used risk-free rate is the US 10-year government bonds, and the yield on those went from 1% to 4% in sort of 12 months. It's now back to about 3.55%. I mean, as that washes through all the valuation models, that has a huge impact on asset valuations, and that impact is only just sort of starting to wash through asset prices now. I mean, it hits the traded ones quicker than the unlisted ones, but surely that's going to keep washing through. I mean, don't you think, James?
Yeah, I think that's right. I mean, I think we haven't seen venture capital valuations move. We haven't seen private equity valuations move. We haven't seen commercial property valuations move in this country, despite falls of 15, 20% in America and Europe. I mean, that is crazy. I don't know what these guys are waiting for. I don't know whether they need a starting pistol to say, wake up to reality, but that is a sector that is heading for some a real reckoning. Speaking of which, Tony, you wrote about some potential turmoil in construction. I mean, it's not SVB related, but it's an example of a pocket of pain in this sector where people have got themselves in a sticky situation.
Yeah, well, I interviewed Tony Lombardo from Lend-Lease. He was in Tokyo on a site visit and managed to take my call, but he basically said that more builders in Australia will go bust. And he says that from a position of strength because Lend-Lease actually is its own building company and developer. So it's not exposed to third-party developers who've done fixed-price contracts before inflation made them uneconomic. But to your point about the valuation of property and commercial property, I did a quick check on Friday of the discount to NTA of some big property companies. And the figures are actually quite shocking in some ways because the unlisted property has not changed and probably gone up. But if you look at Dexus, 30% discount, Cromwell Property and Centuria, 40% discount, GPT and Mirvac, 20% discount. So that's what the day-to-day pricing of the stock market tells you about what they think about the value of commercial property. When will that be reflected in unlisted assets?
Well, June 30 is just around the corner. So, I mean, hopefully in the next couple of months.
Yeah.
Well, this is it. That in itself could be, I suppose, a hit to superannuation funds. But maybe they can just hold on and say everything's fine.
That's going to be tough. Look, I want to finish with a question that I'm going to ask both of you. How should investors be thinking in a time like this? What should they be doing? I mean, I spoke to Peter Harrison, the global CEO of Schroders this week. A fascinating guy, really thoughtful, funny guy actually. His message was look for the leverage, follow the leverage. Wherever there's too much borrowing, that's where you're going to find trouble, which I think is a good place to start. But his other point was that as an asset manager, what he's got to convince people to do is to not panic and not flip-flop. If you get scared now and you sell low and then you buy back in when everything's fine, that is going to kill your profit in your portfolio. It's going to smash your wealth. So I thought they were two good points. Anthony, what else should investors be thinking about?
What we've seen with SVB, Credit Suisse, I mean, it's all about your ability to stay liquid. If you have liquidity, you don't have to panic. You can ride out the tough times and everyone will focus on someone that's in a weaker position than yourself.
Yeah, well, I have a little bit of advice too. And of course, this is not financial advice. Please seek your own advice. But I reckon companies that have strong cash flows and good dividend yields are always going to do well. And just as a sort of little warning signs that I look at, take a look at the 12-month lows each day of the All Ordinaries Index, and you'll find there's about, depending on the day, but you might get 20 to 30 companies will come up. There are often interesting patterns in those lists of stocks, which themselves will tell you what to be wary of. And I won't say any more than that, but it's worth keeping an eye on.
Yeah, great advice, Tony. All right, we're going to take a break and we'll be back. You thought this week was big. Well, next week could be even bigger because the Federal Reserve has got to make a big interest rate decision, and we'll preview that after the break. Okay, well, welcome back. It's another big week ahead of us. On Tuesday, we get the latest minutes from the RBA. I guess Reserve Bank Governor Philip Lowe's been out and about talking plenty about the latest interest rates decision they made earlier this month. So let's see how much new information is there. On Wednesday, we get British inflation numbers. Some big numbers going. They've had double-digit inflation in Britain, so it'll be interesting to see if that's calming down. They'll be hoping for a bit of relief in areas like food prices and energy. And then on Thursday morning, our time, we'll get the big one. The Federal Reserve, the central bank in the US, has to make its latest rates call. And the market has gyrated wildly on what they're going to do. I think about 10 days ago, the expectation was that the Fed could raise interest rates by 0.5%. Then we had SVB and everyone said, oh, maybe they'll pause. Then we had US inflation numbers that looked pretty hot still. And half the market said, okay, maybe it's 0.25%. Anthony, where do we end up? I mean, we've still got 6 days between now and then. We could get another bit of global panic and that'll change the equation again. But what's your best guess at the moment?
Well, yeah, I mean, you can look at all the economic inputs as much as you want, but I think the focus is going to be on contagion in the sort of financial system. Like if another bank or two looks weak and has to get bailed out by some of its peers, which sort of is what's happening, then surely it's going to be hard for the Federal Reserve to do too much on rates.
Yeah, I agree, Anthony. I mean, one of the things I've been watching is the VIX index, which is a measure of volatility. It was down below 20 for many months, and it this week shot up to 26. That is just a measure of how the world is so uncertain and volatile. And with that background, I reckon the Fed's just going to pause for March and maybe come back in April and May. What do you think, James?
Yeah, I'm a bit torn. I think if the Fed believes it's done enough to stabilise the banking system, then it probably leaves itself room to hike by 0.25%. But I'm with Anthony. I think this is going to go right down to the wire. Usually you get the sense the Fed's made the decision by the weekend before, and then they start to sort of soften the market for it. But I think this is a moving picture at the moment. I mean, who knows what blows up next in the next few days. So let's wait and see. We'll dissect that all on next week's podcast. We love getting your questions here at Chanticleer. You can send them into chanticleer@afr.com. And we've got a great question today from Belinda Yang, who's from Norwood in Adelaide. She says, on the day that the Silicon Valley Bank crashed and Bitcoin rallied almost 20%, and pundits were drawing parallels to the Cyprus banking crisis and the Bitcoin rally that followed that. What do you think of the correlation between Bitcoin rallies and bank failures? And do you subscribe to the thesis that Bitcoin is a hedge against inflation and a centralized banking system? Or is Warren Buffett right that it is worthless and he wouldn't pay $25 for all the Bitcoin in the world? Thanks, and loving the new addition to the Chook Pen. Tony, you are our resident Bitcoin expert here on the Chanticleer podcast. Can you please help Belinda out?
Okay, well, look, just a few stats, Belinda. This week, there were 1 million Bitcoin wallets created in about 48 hours. So normally when you get this turmoil in financial markets, runs on banks, what you expect to happen is that people rush into gold. It's supposed to be an inflation hedge, and it's certainly not affected by governments printing money to save banks. But gold, you may have noticed in the week, only went up about 5%. And when I last checked, Bitcoin was up 17%. So, the only thing I can sort of say to explain that is the concern about governments printing money to save banks all around the world has got people once again thinking, what is the asset that is free from that type of flooding or growth in the scale and size of the asset, which is the US dollar. And Bitcoin is one of those things. So the Bitcoin got down to 16,000 last year, and it was predicted to go to 7. And here we are, it's back up at about 26,000. So whether that is the precursor to further increases, I have no idea. But it's certainly been an interesting development this week that it certainly outperformed gold, which was the normal go-to place in times of crisis.
Thank you, Tony. I think it's a good argument there. I'm still not sure of the correlation with inflation. I think there's still a bit of a correlation to speculation for mine at this stage. But we'll bow to the Chook Super Fund's superior knowledge there. Before we go, I've got a recommendation, and that is to check out the program for an event that the AFR is putting on for investors called Alpha Live, which is going to be on in Sydney on April 27 and via virtual passes. We're not big on plugging our events always here, but this has got one of the best programs. We're going to be writing stuff out of this for months, I reckon, Anthony. It's got the boss of the Future Fund, some of the country's top short sellers, big credit managers, lots of great tips from Aussie investors. The big Aussie super funds are going to be there. As I said, you don't have to be necessarily in a room, but virtual passes are available. Go to live.afr.com/Alpha Live, and you can find out a bit more about it. Anthony, it looks a cracking event.
Yeah, and it's all in the timing, like all of these things. Like it's kind of the market that's leading all the sort of corporate news stories at the moment. Yeah. And it has been all this year. So the good thing about these fund managers and strategists and whatnot is they're always topical and moving around with the times. So they always have something good to say.
Yeah, absolutely. Who knows where we'll be in the world by April 27, but there'll be plenty to talk about. Tony, thank you for another big week. I hope you get a little rest on the weekend, and we'll reload for the Fed's decision next week.
Thanks, James. Talk to you next week.
And Anthony, thanks again for joining us. We're loving your contributions, and we'll see you next week as well.
Absolutely.
And thank you for listening. It's been a huge week, and thanks for letting us dig down into this big week of turmoil on global markets. Well, if you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Spotify or Apple or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, Tony Boyd and Anthony Macdonald. The producers are Lap Fan and Alex Gow. Our theme music is by Alex Gow. See you next week.
The Australian Financial Review.